Welcome back everyone to another video by Fully Informed Trade, or Fi Trade for short. My name is Alex and I'm just going to go ahead and review the stock, commodity, bond, and Forex market. So without any further ado, let's go ahead and get into the data. First of all, market has pulled back a bit and is touching this key trend line area. If we go ahead and redraw that a bit, it's pretty much at $78. And $78 is a key area of support, and not only that, the euro is finding some key area of resistance. So if you take 1 plus 1, you'll realize that these two markets are having some support, some resistance. They could go in the opposite direction from each other. Let's go ahead and look at the next chart. And this is the Euro US dollar, by the way. Next chart, which is going to be the index Dow Jones Industrial Average. Dow Jones Industrial Average does have an inverse hammer on the chart to top it off. And also, it did go above the key area of resistance that I pointed out, which is 11,867. It closed at around 11,871. Today was a surprising day. I honestly was anticipating people to go ahead and sell their stocks, but instead they started to buy stocks before the weekend, which doesn't really make much sense. But then again, markets aren't always sensible. But remember, when you're a trader, you're just trying to be right more often than you're trying to be right more often than wrong. So, give or take, this is one of my wrong moments, but remember, you can't be wrong. You can't be right 100% of the time, and pretty much, the market participants reacted completely different and acted differently, completely different from what I was anticipating. Next chart is pretty much the S&P 500 cash, and pretty much S&P 500 is, has some key things that I don't like going for it. First of all, engulfing bear pattern. Cross plus an inverse hammer. Those are very negative. I honestly don't feel that the markets could sustain this rally that they've been going on for such a long period of time. And on top of that, you have a lot of people talking about, oh, the markets could go to 1,350, 1,400s next area. I mean, come on, guys. You got to be a little more realistic here. You got to be cautious at these levels, because every time the market goes up significantly and they're making a lot of, or a pretty decent amount of money, it's always these group of people that say, hey, shut up. I'm right. I'm going to keep on buying these stocks. I honestly don't care what you guys think. You guys are idiots if you guys don't keep on buying stocks. That's the whole entire mentality that some people have. And you got to be very careful of that, especially when you get towards the oversold area in the market. So at this point, far more safe to be hedging your portfolio, looking for short and long opportunities, and short and long opportunities in the sense of you buy a stock for a couple days and then you turn around and sell it, or you short a stock for a couple days and you turn around and get rid of it. And I'll give you guys a couple examples of that. But for right now, let's go ahead and look at the next chart, which is going to be the gold market. And the gold market, same story here. You have some pundits coming out there, or some people in different markets saying, "Hey, gold could go all the way up to 100,000." And I'm trying to envision that, and that would mean that the dollar would have to inflate so much that our dollars would have to be worth so little to the point that gold would have to be worth so much. I mean, that would mean that, since the average laborer earns, let's say, $2,000 a month, I guess, or $3,000 a month, and gold were to go up by that much, that would mean that gold went up to 100,000. That would mean that the average wage worker would probably have to earn $300,000 per month to keep up with that type of appreciation in the gold market. Of course, that doesn't always mean that gold is indicative of current consumer prices, or what is it called again, the consumer price index, but that just gives you a basic idea of, like, if this commodity moves up, just in general, you have this whole entire effect, the symphony effect of a bunch of commodities moving up together, because if they say, oh, that commodity is going up, that means that the dollar is inflating, because the dollar will inflate if the dollar index does move down when gold goes up. So if that happens, people are going to be like, oh, maybe our commodities should be worth more since the dollar index is going down. And likewise, there's all these factors to go over. But pretty much, it's unrealistic. You guys got to keep those high expectations away from the trading pits, away from the markets, because it's not worth it. And if you're a short-term trader, all the more reason not to buy into that. As of right now, gold market continues to pull back. And pretty much we have a good area of support around 1,295. Market has traded below a lot of previous support levels, and it has fallen below a ton of major support levels on certain moving averages. And to top it off, you got the 20-day moving average crossing under the 50-day moving average, which is very negative. That is very negative, guys. So you got to be careful in the gold market. Right now, there's a good opportunity of going ahead and continuing a short position, having a relatively tight trailing stop, so you can continue to take advantage of the gold market's depreciation. For that matter, if there's a good area of support, it would be around 1,295. That's when you should take your shorts off the table. You could buy back into it and have a pretty tight trailing stop, so you can earn a quick amount of money off a dead cat bounce. Or, some people call it dead cat bounce, other people call it a quick relief rally. You could buy right back into that relief rally, take most of whatever that's in the relief rally, and once the relief rally has its pullback and continues its next leg down, you will be able to keep most of your money, and then you can resume your short position again. Let's go ahead and look at the next chart, which is going to be the silver spot. Silver spot, same story here. I drew in the pyramid, and you have various support levels along down the way, $27 being one of them. The next level of support is around $25. The next, and I know these lines aren't exactly straight, but come on, I mean, I drew them on the spot, but pretty much various support levels at around 27, 25, 23, 22, 21.50, and around $20 is the lowest area of support. What we could do is continue shorting this market and doing some tight trailing stops as we keep on making money. But right now, this market has been able to find some support on the $27 level, and each time you find support on these key levels, what you could do is you could buy into it, set up a pretty tight trailing stop, earn some money off of it, and when the market turns back down and has, like what I mean by turns back down, it goes up a bit and turns back down, what you could do is buy into these type of movements, and then you could set a pretty tight trailing stop. So even if it pulls back a bit, you get to keep most of whatever you made in those bullish engulfing candlesticks as it continues its downwards trend. Alright? But right now, likelihood of us finding support is somewhere around the 20, 23, 24 area, maybe around 26 area. But don't buy in at every single level unless if you have some tight trailing stops and you want to take it, if you consider these short-term profits, because the overall trend is still negative on silver. As the trade triangles have indicated, the midterm and short-term trend are negative, and we have a negative 70 score on the silver market. In the past, silver market has performed really poorly. As you can see back here, silver has fallen by 50% in the past. A 50% fall in any market, and with a similar slope, even a worse slope, because this slope, if you look at this slope, this angle is far more slanted. It's far more slanted higher than this one. Because I mean, this slope right here, if you look at it, is directly like that. I mean, if you look at the angle that you're getting, it's completely different from this one right here. So pretty much, this slope is far more close to 90 degrees than this one, and because of that, if this market were to pull back, it would probably be more severe than this one right here. So because of that, be careful, anticipate more weakness in the silver market, because whenever it sells off big. Let's go ahead and look at the next chart, which is going to be the crude oil market. Crude oil market has an inverse hammer plus a red triangle, which is pretty much a short-term negative indication of trend. We could anticipate an inverse head and shoulder, or an inverse, not inverse anything, but pretty much a cup and handle position as well. Next thing is there's some support on the 20-day moving average, which will most likely be broken, but if it finds some support on the 50-day moving average, everything is nullified. So you got to watch that 50-day moving average very closely. If it can break the 50-day moving average, the next area of support would be the 100-day moving average. Next chart is the bond market. Bond market, same story here. Support and resistance would be at, the support area would be around 120, give or take 120, somewhere around there towards the bottom of these candlesticks. Buy in at these levels, and you sell at those levels, or you sell short at these levels, and you cover at these levels, and you'll do just fine as a bond trader as of this moment. The likelihood of this market breaking above this trend line is more likely than breaking below this trend line, mainly because of the cycle we're in the stock market. Stock market could have a major pullback, which will most likely have a major pullback in the near future, and once it does, the bond market will most likely break that 122 area of resistance. Next chart here is going to be the JP Morgan and Chase. I honestly pointed out the 20-day moving average as being a key area of support in the past. But likewise, once you break this 20-day moving average, you'll have a high probability, high risk to reward trade in the financial markets. And I've tried buying financial stocks after earnings, and generally speaking, they've fallen down every single time. So I decided, instead of buying financial stocks, it's much more smart to short. Or if you already bought them at a lower level, let's say back at 39 or 40 bucks per share, then you might as well just hedge your positions with February or March put options, because that will protect your portfolio, and whatever money you make off of that hedge, you could reinvest into JP Morgan and Chase and continue that cost averaging strategy that you may have in place. Let's go ahead and look at the next chart, which is going to be the McDonald's Corporation. McDonald's, you know, I told you guys to take your money off McDonald's back, I think 2 days ago, or either yesterday, yeah, most likely, yeah, 2 days ago. And then if you were to take your money off the table, that would have been yesterday morning. And pretty much the main reason is because I saw this chart having trouble breaking above the 20-day moving average, and even if it did, it fell right below it, and if it can't really break above this area, because the dollar index, and you know, even the dollar index is going down in value right now, and if the dollar index is continuing its downward trend, which it kind of is, and and McDonald's isn't going up with it, there's something seriously wrong here. That means that the traders themselves are not interested in buying up any more McDonald's shares. Because of that, it is a very, very risky play at this point. And also, another key thing about McDonald's is that a lot of commodities are going up in price. Stuff like potatoes, wheat, corn. Corn is very important because corn goes in soda through high fructose corn syrup. And if that if soda becomes more expensive, then that hurts McDonald's bottom line at a very in a very tight margin. But still, there's a lot of speculation that China and its overconsumptive ability, the fact that they have such a huge amount of population buying food at this moment, constantly driving up the price of commodities. So a lot of it has to do with China, and because of that, McDonald's could be hurt pretty bad. But there is a good point to McDonald's, is that it is growing very fast in emerging markets like China and India. But that doesn't change the fact that commodity prices are continuing to go higher, and that is going to hurt McDonald's profits over the longer and short term. Next chart is American International Group. American International Group does find some support at this level that I mentioned, this key support level. So you got to watch this very closely, and you should not trade this level. You should not short at this level. In fact, right now is a good scalping opportunity to go ahead and buy into it and put a tight trailing stop on it, so you can make whatever money you can. And if the market continues this downward trend, you'll be able to keep most of your profits intact. That's all I have to go over for today. And please be sure to check out my videos in the near future. Please subscribe to my channel, and if you're on Facebook, tell your friends about me, because I will accept any friend request for that matter. And also, if you want to use the same charting software that I use, the same trading software, same charting software, I mean, please be sure to go ahead and check out the link below this video. Take care, all of you, and I will go ahead and see you in the coming weeks and months ahead.